And get started. I really appreciate everyone's attendance this morning. My name's Eric Daly. I'm managing principal of Multnomah Group, and today we're going to talk about the topic of record-keeping fee compression, which by and large has been a positive phenomenon. But like so many things, with that compression has come other issues that have arisen for retirement plan sponsors that create both risk for plan fiduciaries potentially, as well as potential diminished returns for unaware participants who may fall victim to the consequences of those changes. A few housekeeping items before I get started today. The first of which is we're recording today's presentation. So the hope is that if you find something that you either like and want to go back to, share, or you need to have it on record for future use, we should have a copy of that provided to you in the next couple of weeks. Along with that recorded presentation will be a copy of today's materials. So don't feel like you need to screenshot every page of the presentation. You'll get a nice PDF that has that included with it. So you can go back and refer to some of the charts and topics that we may go over today. Last, your lines have been muted for call quality and recording quality. However, I'm always happy to take questions as we go through the presentation. My hope is that we'll be in a position to get you good information that you can use and take back. You may have specific questions that you generate over the course of today's presentation. If so, you'll note that there's a Q&A section to the Zoom application. I'd encourage you to type those out anytime you feel like you've got a question that you'd like to see answered or may not have gotten to yet. I'll either get it over the course of the presentation, or at the very worst, I'll get back to you directly with a response. So with that, I'll go ahead and get started. As I mentioned previously, my name is Eric Daly. My role within the firm is really twofold. One is I consult with a number of clients across the country, helping them design and run more effective retirement benefit plans as a fiduciary to those plans. The second is I'm a member of the management group and one of the founding principals here of Multnomah Group. I'm going to cover really 5 things over the course of today's agenda. The first of which is just to give you some historical context about what this fee compression's been like, because it's been significant and material, and it's really been driven by a couple of different phenomena, and I want to be able to touch on those. Second, I want to also help indicate how much pressure that puts on the provider marketplace, and ultimately what impact that may have on you as plan fiduciaries relative provider choice. We're seeing consolidation. The consolidation reduces the number of opportunities or potential providers in the marketplace. And while the scale of that may drive down costs in the near term, there certainly are potential risks in the long term as the number of qualified candidates declines. We're going to talk about what we see as a fundamental shift that many providers are engaged in, which changes the relationship from record keeping as a revenue and profit line to retirement plan administration more as a subscription model, and the impacts of that relative to other industries where we've seen similar changes. The fourth, the risks and strategies ultimately in managing your retirement benefit plan providers given these changes that we're experiencing. And then last but not least, a little bit of fortune telling as it relates to what we think will be happening over the course of the next several years. Let's start on the history of fee compression side. I started my retirement plan industry experience in the mid-90s. I went to work at a third-party administration firm. The firm did testing, compliance, Form 5500s, disclosures, all the typical work that a qualified retirement plan would generally need on the back end. And in the mid-90s, there really were 2 types of firms. There were investment providers, largely organizations that were selling mutual funds or annuity products that were providing record-keeping administration as a method or an avenue through which to distribute those products. And on the other side, you had third-party administrators whose job it was to do compliance testing, Form 5500 filing, but their relationship was almost exclusively with the plan sponsor. They didn't have a participating stake in the asset side of the business. And when I started in the mid-90s, that's largely where the market resided. And my first job in the mid-90s was ultimately putting together employee benefit education packets, essentially stapling fact sheets together, stapling summary plan descriptions, collating them, putting them in a folder to give to a broker, because our third-party administration firm was in the midst of doing what at the time was relatively common. You saw third-party administration firms looking at the marketplace and saying, there's a lot more money to be made if we can sell investment products, if we can participate on the investment side of the house. So the firm that I worked for had hired a broker. I was essentially the broker's assistant as he went out and tried to sell investment products that generated asset-based revenue for the firm to the retirement plan sponsors who were already record-keeping administration clients of the third-party administration firm. Simultaneous to that, the investment provider side were being pushed to do more. As plans became larger and more complicated, they had to augment, develop plan document support services. They had to develop better administration compliance services, be more hands-on with clients to address these growing defined contribution plans. The mid-1990s was certainly a point at which retirement plans began to grow in a very rapid fashion as the defined benefit marketplace continued to constrict. Defined contribution 401k plans continued to grow. And these investment providers that saw what was happening on the third-party administration side said, we need to provide those services or risk losing client control as a result of that outcome. So in the mid-1990s, we began to see a pretty aggressive movement where investment providers added more third-party administrative type solutions, in some cases even acquired third-party administration firms, where simultaneously what had traditionally been largely accounting firms, for lack of a better term, third-party administrators began adding brokerage and investment capabilities to help support the clients they ultimately were working with. Then you lay over that, another 10 years later, the beginning of what I would consider to be the regulatory history of fee compression. In 2006, we saw the Pension Protection Act come into being. And the 2006 was really a fundamental change point for defined contribution plans. Plans that had largely been mixes of 10 to 15 to 20 to 25 different investment options now began to drive very quickly to a model where target date funds began to become the dominant investment holding within retirement plans. That same year, Schlichter, Bogart, and Denton, a large plaintiff's attorney firm out of St. Louis, Missouri, filed the first class action suit against a plan fiduciary for failing to adequately monitor retirement plan expenses. The Department of Labor quickly came to the fore and said, we need to drive the disclosure, make sure that it's fair, make sure that it's consistent across all types of plans. And as a result of that, in 2009, the Department of Labor added to their Form 5500 a much more comprehensive Schedule C. The Schedule C was designed to better disclose both direct compensation, which had always been a part of the Schedule C, paid by the plan directly out of the trust, as well as indirect compensation, meaning compensation received not directly from the trust, but as a result of the relationship the organization had with the plan. That helped illuminate a number of the revenue sharing or other soft dollar compensation practices that were very, very common in the mid-2000s in the retirement plan industry. The Department of Labor continued on in 2010, adding 404A5 fee disclosure regulations, wherein plan sponsors were now legally obligated to provide a consistent, comprehensive, and quote-unquote easy to utilize disclosure of both investment performance and expenses that both were being incurred and could potentially be incurred by participating in the retirement plan. So this created obviously greater transparency into the process. In 2011, the Department of Labor publishes their Understanding Retirement Plan Fees Guide, a piece designed to help both plan participants and plan sponsors better understand retirement plan expenses and their impact on retirement security. And then last but not least, in 2012, the Department of Labor released their 408B2 regulations, wherein service providers, whether they were fiduciaries or not, had to provide disclosures to retirement plan administrators relative their standing as a fiduciary and how they were receiving compensation for the services they provide. All of these regulatory items from a fee compression perspective were happening simultaneous to tremendous review and impact and pressure from the media marketplace as well. The Wall Street Journal had multiple pieces on retirement plan fees. Frontline had a particularly impactful piece in their series about the impact of retirement plan expenses. The New York Times, 60 Minutes, even a couple of years ago, John Oliver on Last Week Tonight, having pieces that talked about expenses and their impact on retirement plan preparedness. And all of those factors have clearly had a massive impression on compressing fees and bringing the cost of participating into these defined contribution retirement settings down to a reasonable level. During the same period of time, the mid-2000s on, we've seen a tremendous uptick in assets within defined contribution plans. If we go back to 2007, 401k plans had about $3 trillion in assets. Other defined contribution, be it 403b or 457, added another 1.6 trillion. So $4.6 trillion total in the defined contribution marketplace. A mere 10 years later, at the end of the third quarter, which obviously is relatively consistent with where markets sit today, the 401k marketplace had nearly doubled to $5.6 trillion. And similarly, we'd seen huge expansion in the defined contribution side, where the entirety of the defined contribution marketplace for qualified retirement plans is now $8.1 trillion. The economic opportunity continued to be very attractive, simultaneous to fees being compressed extraordinarily on the record-keeping administration side. Important to point out that that's likely to continue. So while $8.1 trillion is a tremendous amount of assets, still only 28% of all retirement assets held in the United States. So if you add IRA accounts, obviously public and private pensions, that begins to expand that asset base to even higher levels. And with the diminishing use of defined benefit plans, more and more participants who are eligible for defined benefit plans ultimately beginning to receive benefits as the baby boom generation makes their way into the distribution phase, the overall market share of defined contribution plans relative retirement should continue to grow, and assets you would expect to grow in kind. And there's been things happening on the vendor side too. So it wouldn't be accurate to say that vendor fee compression was entirely driven by participants and rage from media, from the regulatory environment as it stood. There were things that were happening on the provider side that also helped fuel that consolidation or that compression. One of the material ones ultimately being vendor consolidation. The number of potential providers continued to decline, and I'll give you some information on that. But ultimately, more and more record keepers exiting the business, combining, trying to drive scale. That greater provider scale, ultimately creating a bogey under which developing these solutions has a certain fixed cost. If we can obviously amortize that fixed cost over a larger plan base and a larger participant base, it should improve our profitability relative to what we're doing on the retirement side. Some of it certainly has been helped by improved technology. Payroll feeds have gotten better. The ability to take data, sort it, order it in a way that's consistent has become much easier for record keepers. And as a result, that has certainly helped diminish the amount of time and effort and manual labor that needs to be spent touching data and moving data from point A to point B. So that certainly has helped some of this fee compression that we've experienced. But we've also had greater utilization of technology on the employee education and guidance side. So less and less clients are demanding someone come out, sit in a conference room for a protracted period of time to individually meet with participants. The advent of automatic enrollment, auto escalation, QDI default investments to drive the asset allocation process has diminished in many plan sponsor realms the need for that hand-holding process, thereby driving down costs, because most of the costs relative retirement plan administration record keeping are leverageable costs. They're costs that ultimately can be spread across a larger and larger participant base. The one that cannot is clearly that education piece. When that employee educator is on a campus is in a cafeteria, is on a shop floor, that's the only place they can be. They can't be doing that for other places. So the development of greater education tools, better technology on the participant side clearly has helped. But even the simplification of plan design has assisted in reducing administrative and record-keeping costs. More plans that rely on safe harbor outcomes, less testing, less complicated structures ultimately have diminished the need to have highly trained ERISA administrators running some of these plans and being able to do it at more junior pay levels. All of those things have had an impact on compressing fees, bringing fees down, and the fee reductions that we've experienced in the 15 years that we've been doing fee benchmarking have been relatively extraordinary, really across all plan size points. But it has, without question, had a pretty material impact on how profitable it is to be a record-keeping administration-only firm in today's marketplace. So in looking back, there's a great article from Greg Ituri at Investment News that takes a look at some of the larger record-keeping mergers that have taken place over this realm of fee compression. And it goes back to one of the first where there was publicly available data, which was when Prudential acquired Cigna back in 2003. When Prudential acquired Cigna, they picked up $50 billion in assets under administration. Prudential paid $2.1 billion to Cigna for the purchase of that administrative record-keeping platform. And what that ultimately means is that they paid 0.42 or 42 basis points of the total assets that Cigna had under their control for administration. Relatively significant premium, paying $2.1 billion on $50 billion in assets that are picked up was significant. You need only roll the clock forward to 2008, the Mass Mutual acquisition of Hartford, or the ING acquisition of City Street. In both cases, big books of business. But even in the case of ING's acquisition of City Street, where they're picking up $262 billion, the transaction cost was under $1 billion for ING. So from 2003, deal cost of 42 basis points goes down to, in the case of ING and Mass Mutual, cost over assets that's 3 to 7 basis points, significantly less attractive from an acquirer's perspective in looking at what the profitability or the opportunity to sell products and services and generate revenue are under these acquisition models. And then the most recent that we have data on is certainly Principal's acquisition of the Wells Fargo retirement book of business. Wells Fargo had grown their business relatively significantly in 2008, 2009, 2010, when they picked up, through the economic crisis, the acquisition of Wachovia and Comerica's retirement business and merged it with their own practice. Deciding in 2019 to exit the business, Principal will pick up $827 billion in current assets under administration at Wells Fargo, and will pay $1.2 billion. And the cost then of acquisition at this point declines to 1.5 basis points. So indicative of what buyers are willing to pay for administration, the profitability of record-keeping administration as a standalone business line continues to become less and less attractive. So if it's less and less attractive, why then ultimately would anybody be in the business of either record-keeping or certainly in the business of ultimately acquiring? Well, on one side clearly is the scale element, going back to, well, if I've got a large fixed cost base, if I can spread that out over a larger number of plans, participants, and assets, that should help the scale game. But the scale game's been a difficult one. If you look back even over the last 5 years, the number of deals that have gone down, we have continued to see significant exiting of the retirement plan administration book. Great West Putnam and the roll-up into Empower back in 2014 was material. Newport's acquisition by Verisight in 2014 was material. Clearly, when New York Life sold to John Hancock in 2015, that was material. Mercer selling their record-keeping business to Transamerica in 2015 was material. All of these are reducing the number of providers and generating greater scale on the back end of the system. But even with that level of compression and that increase to scale, we've noticed what I would consider to be the more material opportunity set for those that have continued in the record-keeping administration business. I want to take a step back from retirement and talk about what participants are seeing outside their retirement plan as they engage kind of economically with the marketplace. And one of the ones that fascinates me ultimately is my two children, 16 and 11. Both have healthy, I hope, fascinations with various online games. Online games that they really don't have to pay a single penny for, right? They can download them from the Apple Store, play them on an iPhone or iPad. And how is that possible, right? How can a organization, a for-profit company, put out a product that ultimately carries no revenue to them when my child downloads it to their phone, and still turn that into a business that allows them to pay developers and marketers, and even have commercials on TV during the Super Bowl about these games that have no cost. There was a great piece in the LA Times from a few years ago that talked about this model and this transition from selling a product or service to ultimately finding other ways to generate revenue by using a product or service almost as a Trojan horse into a larger financial engagement. So let's take a look at Farmville. I know Farmville is a couple of years older. My kids probably don't even know what Farmville is. But back in 2010, Farmville was arguably the largest online game out there. It was distributed largely through Facebook, although you could pick it up other places. And when the CEO of Farmville talked about the economic model at the time, he said, it's relatively simple. It only costs us from a development perspective, less than $500,000 to develop one of these games. Pay programmers, get it, distribute it. We can distribute it for free. However, the data says that between 3 and 5% of people who utilize or play these types of social games in this environment are willing to pay money to sign up for things. Either they're willing to accept advertising if they don't buy things, they're willing to pay for a premium that has no advertising, or they're willing to buy things like better characters, better tools, better opportunities to win, advance, or develop better crops in the case of Farmville. So back in 2010, Farmville was played by about 31 million people every day. And given the metrics above, that means that on average, one of those, each of those players was probably good for a penny a day in revenue based on the various opportunities to either upgrade, sell advertising, or receive upgrades from the game itself. So if you took that 365 days, a penny a day, 365 times 31 million people playing it each day is $113 million a year in revenue. So a simple less than $500,000 investment in Farmville and developing the solution for it, creating a pretty significant annuity, not by charging for the service itself, but by charging for other services around the Farmville or any of these online games that create a better environment where participants may seek to advance themselves or buy those services either willingly or unwittingly, depending on the situation. One that I'm more familiar with is Dollar Shave Club. I don't go to the store to buy my razors now. For a nominal fee, they'll ship me a pack every month of 4 to 5 razors. I snap them on my razor back, and I don't have to go to the store and deal with the pharmacy to try and get my shaving needs met. So what's the Dollar Shave Club model? It's another subscription type model, although in a slightly different format. So ultimately, if I'm Dollar Shave Club, if I'm selling razors to most of my constituents, I only really need to recoup the cost of the razor itself, right? I got to pay for the razor, I got to pay for shipping, and I got to pay for the cute cardboard box that it comes in. My opportunity for profits may come from the other things I can sell. better blades, deodorants and wipes, shower products, the list goes on. Higher margin issues where participants then opt in and say, well, I'm already receiving A, and if I add to it B, C, D, and E, it's just more convenient than, again, me having to go out to another organization. So how do those two subscription type models impact how we might look at the record keeping administration, fee compression and consolidation that we're looking at today? And I would argue, it's probably indisputable that at some degree, the retirement plan marketplace is moving in a very similar fashion. The compression has made it such that the actual act of providing record keeping, administration, and compliance services is relatively unattractive, certainly relatively unattractive for large, globally diversified financial service organizations that have much, much more profitable revenue lines. So if I am one of those institutions, if I'm Principal, if I'm a mutual fund company, why would I be looking at continuing to grow record keeping administration? Well, I think the subscription model is a relatively simple one, right? There are other revenue opportunities for record keeping administration firms to try and generate additional income or profitability based on their relationship with the plan sponsor. One of those would be proprietary funds, the ability to distribute funds that they may manufacture. The investment management marketplace is a very, very profitable one. And having an $8.1 trillion retirement marketplace through which to distribute them, especially in record-keeping administration cases, is highly attractive. Managed accounts. So with more and more participants choosing not to engage and instead using products like target date funds to manage their asset allocation process, record-keeping organizations have said, I've got something that's an alternative to a target date fund. You can use a managed account where you pay me, the service provider, to manage your account using the underlying funds in a manner that's consistent with your time horizon, your risk preferences, and other things that you may have shared with us. Clearly, the IRA rollover market is a very attractive one. People are transitioning multiple times over a working career. And at each of those transition points, there is an opportunity for a participant to either A, leave money in the retirement plan where they used to work, B, roll that money into an IRA account, or C, take a taxable distribution. And certainly that massive IRA marketplace is funded to a very significant degree by IRA rollovers and the opportunity in the retail setting for financial services institutions to be successful there. 4, going back to those globally diversified financial services institutions, the notion of cross-selling products and services. It could be cross-selling products to the plan sponsor. It could be payroll processing, HSA services, disability policies, other insurance policies that may be available in the marketplace. But more realistically, the cross-selling is happening at the participant level. So whether I'm at Farmville or I'm in my Dollar Shave Club, do I want to buy a better tractor for my Farmville that is outside? Do I want to buy a better smelling cologne from Dollar Shave Club to make my wife happy? All of those cross-selling opportunities create financial opportunities for the record-keeping service provider who has that relationship with the participant through this subscription type model. And last, because it's typically done last, is the annuitization phase. So in the defined contribution marketplace, as we've transitioned away from the pension defined benefit market to a defined contribution setting, we continue to see an environment in which organizations are encouraging participants to review the benefits of annuitizing, essentially transitioning what is an accumulated dollar base of assets in a defined contribution plan over to the receipt of annualized income by purchasing an annuity, frequently an annuity that would be from the organization that's providing record-keeping administrative services to the plan. So let me talk about those in a little greater detail, because I think the transition has been fundamental, and I think it's really at this point, fee compression is, to our mind, no longer being driven by the regulatory environment. It's no longer being driven by the economies of scale that have been achieved in the marketplace. but instead is by and large being driven by these external factors. And one of them is proprietary funds. If we go back to, again, the mid-1990s, ultimately the firms that were providing record-keeping administration services on the financial services side were doing so almost exclusively to distribute investment products. As a matter of fact, they were closed architecture investment universes. You could hire T. Rowe Price or American Funds or Fidelity or some other organization to provide record-keeping administration, but that would mean you would have a menu that was comprised entirely of those investment products. There still is a tremendous advantage to being the record keeper administrator as it relates to distributing investment products, even though the impact of that is much less significant than it was in the mid-1990s. Familiarity with the organization that's record keeping makes putting those funds on menus easier for plan sponsors, but significantly, there is pressure within 3 specific markets where we continue to see heavy proprietary fund usage, and that is driving profitability for these record-keeping administration organizations. Clearly, one of which, and maybe the most important, is on the target date side. Target date investments take a tremendous number of the new enrollment dollars, and assets within target date funds are growing at a much faster rate than the marketplace as a whole because they're picking up greater market share from the other investment options. Second is cash options. So looking whether it's at money market solutions, fixed annuity solutions, or stable value solutions. In all of those areas, proprietary record keepers are pushing for shelf space for their products. So typically insurance companies that are providing record keeping administration may be pushing for a fixed annuity solution. Mutual fund companies may be doing it through either stable value or money market allocations. But the correlations between record keeper and product usage in the cash side continue to be very high. And similarly on the index side, although ultimately on the index side, that issue may be resolving itself relatively quickly. With fee compression on the record keeping side, the only place we've seen it more aggressive is probably in index pricing. So when we look at BlackRock, Vanguard, and Fidelity, the efforts the 3 organizations have gone to try and make their particular investment products the least expensive at any given price point certainly has taken much of the profitability opportunity out of the index space. There was a great study by AllianceBernstein and Brightscope back in 2017 that looked at the market. And back in 2017, 43% of sponsors were still using a proprietary target date fund in their plan. So to think that there isn't some economic advantage to a mutual fund company or other investment manager to do record keeping seems to miss the data, which looks like that the overwhelming number of plan sponsors still use target date sets almost as a default package that comes with their record-keeping administration provider. But if you're to look at target dates, cash, and index options, I looked over our book of business, which covers hundreds of or dozens of clients, well over 100, nearly 200 plans, and over 21 billion in assets. In looking at our book, between target date funds, cash options, and index options, that's 62% of the client assets that we consult on. So having shelving advantages as a record keeper in those 3 areas gives you exposure to 2/3, at least arguably, of plan assets that you may be record keeping and providing administrative services to. A huge revenue opportunity, because keep in mind, again, proprietary funds, entirely leveraged environment. Those products have asset-based revenues. The cost of adding $1 of assets is virtually nothing because the record keeper is handling the relationship. There is no relationship to the fundamental participant. Therefore, every $1 that's added should be marginal revenue and profitability for the financial services company. Maybe the area where we've seen the greatest amount of effort exerted by the record-keeping industry over the last couple of years has been on the managed account side. So again, managed accounts are a relatively simple phenomenon, which is You, participant, don't know anything about investing. I know a lot about you, and you could even tell me more. And based on that information, I'll look at the funds that are available in the marketplace and come up with an allocation that I manage and rebalance for you. It is a tremendous opportunity for record keepers because the process of managing those participant accounts is largely one they've already paid for. The record-keeping administration systems are in place. Managed accounts are not an individual broker sitting in an office making determinations. They're driven by algorithms that have already been deployed and are being used with other clients. So ultimately, the marginal cost of adding another managed account is virtually nothing, but the pricing marketplace for them is traditionally somewhere between 0.3 and 0.5%. So given the amount of fee compression, to have participants elect into a solution where they might pay a record-keeping administration provider 30 to 50 basis points is highly attractive. And the benefit is that ultimately the record keeper is replacing the low-cost target date funds, which are generating, in some cases, negligible or no revenue for record keeper, with something that can create tremendous profitability. And the impact is consistent. As we run RFPs, we continue to find that service providers offer pricing that comes without offering a managed account, a different price for a client who says we would wish to buy an opt-in managed account, and a different price for a provider, or pardon me, a plan sponsor who says we'll default participants into a managed account. The materiality of those pricing differences can be as much as 300% from top to bottom. So the profitability of the managed account section is clearly having an impact, and it creates an opportunity. It's not to say that any of these fundamentally are bad or wrong, right? A great proprietary fund, if it's a great fund, should be utilized. A managed account solution that helps drive better outcomes for participants, net of fees, should certainly be considered and utilized. But the notion is, at least from our perspective, the communication is coming as sells to participants rather than discussions that educated plan fiduciaries are having and making dedicated decisions about the purchases of solutions. So if you look at the 2017 PSCA annual survey, 39% of all plans were offering a managed account solution. And in almost all cases, 76% of the 39%, those fees are being paid by participants. And it's a more attractive selling opportunity if I'm a record keeper administrator. You, plan sponsor, can offer this service that plan participants can either buy or not buy. You, plan sponsor, don't have to pay for it. It's just another option. So while that's a really attractive approach and can be compelling for plan sponsors, it does create risks. Anytime you allow plan fees to be deducted from the trust or the plan, and certainly that happens in the case of managed accounts, you have the same obligations of fee reasonableness that we have for record-keeping administration, for investment management products. And I think frequently plan fiduciaries are getting lost in that transition, saying, I'm going to offer it, I don't pay for it, participants can buy it or not. And while that decision-making line is relatively clear, it's not one that's consistent with the obligations of plan fiduciaries under ERISA. Let's take a look at the IRA rollover market. Another tremendous opportunity for record-keeping administration organizations. This has been an area where the Department of Labor has relatively consistently been concerned, going back, really over the same period of time that the fee disclosure regulations that I mentioned previously. So the IRA marketplace is currently a $9.1 trillion marketplace, actually larger than the defined contribution marketplace. However, the primary method of funding is certainly not $2,000 IRA contributions to participants who are eligible to make deductible contributions. It's rollovers from qualified retirement plans. The Department of Labor had a significant concern that financial services organizations were targeting retirement plan participants, providing them inaccurate or incomplete information as a result to get them out of institutionally priced retirement plans and into retail priced IRA accounts. They were so concerned, as a matter of fact, that back in 2016, they put together a more comprehensive fiduciary framework that would have created significant liability for individuals, financial service companies, and other practitioners who were rolling people out of retirement plans in situations that were not in the best interest of the participant. That was a significant effort and potentially could have gone a long way to helping alleviate this concern over conflicts in the IRA rollover market. But as has been written about very, very frequently, in 2018, the fiduciary rule was killed in the federal courts. And as a result of that, we continue to see the same practices in 2019 that we saw in 2009 and 1999, which is financial services organizations soliciting heavily IRA rollovers out of retirement plans and into less regulated retail IRA solutions. So how does this impact then the record-keeping administration marketplace? Pretty significantly. Again, the notion of consolidation and operation needs, whether you're Amazon and I can buy toilet paper and food from Whole Foods and a bed and a movie and watch TV all through one interface, the same is true of financial service consolidation. So if I've grown accustomed to working in a record-keeping scenario with a retirement plan organization, I know the framework, I have my login, I know how the website works. Does it make it more likely that within that construct I'm going to open an IRA account? And the data would support yes, that organizations that invest in that relationship, both A, have access to information as participants near retirement and could become eligible for an IRA rollover, and B, invest time, energy, and training with their financial consulting teams to try and help them be more effective in capturing IRA rollover dollars. So the issue here is not so much that you as a plan sponsor care whether they buy IRA rollover product A or B, but in providing information to the record-keeping administrative organization, have you created an environment where participants are being targeted ultimately within the retirement plan setting? Cross-selling and retail financial services products. So really back to the prior phenomena, this is a very strong example of that subscription model mentality. If you look at the amount of data that's provided in a record-keeping administration setting, it's pretty significant. I mean, you see movies about buying lists, right? If you're a salesperson, you're trying to sell Swampland and Boca Raton, you need a list of potential candidates. If you watch The Boiler Room or any of those brokerage movies, they're looking for lists of people with money that they can sell things to. And retirement plans become a pretty significant marketplace where you could have that, right? The data that you share as a plan sponsor with a record keeper includes the income of the employee, how long they've been on the job, their marital status, where they live, what their saving rates are, in some cases their risk tolerance. All of those things, their age, all of those things would be materially useful to someone who's in the process of selling products and services. They're also absolutely fundamentally necessary to running a qualified retirement plan under internal revenue codes. But what processes are in place to try and create that delineation? And it's become further confused or muddied over the course of the last 5 years as the dialogue has transitioned into financial wellness. So financial wellness clearly has an impact on retirement savings. But when we operate and talk outside the spectrum of exclusively retirement savings, we typically open up dialogues that may talk about your need to have long-term care policy, your life insurance needs, your 529 savings needs, your taxable retirement savings needs. Those can be very valuable conversations that help participants make better decisions and better prepare themselves for retirement, but they carry risks. The most significant of which, for those that have been watching it, has been the class action case brought by participants at Vanderbilt University. And within that particular class action case, not surprisingly brought by Schlichter, who I mentioned earlier, they alleged that ultimately the defendants, the plan sponsors, had breached their fiduciary duty by providing sensitive and private information to an organization that then used that information to sell them products and wealth management solutions outside the plan. So while not directly within the retirement plan and therefore an ERISA breach, the claim here was you didn't protect us from an ERISA perspective, and as a result, we were taken advantage of outside the retirement plan. We just received a note that Vanderbilt settled that case for $14.5 million. Obviously, when there's a settlement like this, there's no admission of guilt, nor would you expect one to be. But the significant size of the settlement would lead you to believe that Schlichter may use very similar methodologies in future class action suits. This was settled relatively quickly, relatively inexpensively, at least from Schlichter's perspective. So the opportunity set creates opportunities for them going forward as they look at this as a potential revenue model. And then last but not least is annuitization, right? Annuitization, you're at the end of your career. You've accumulated a 6 to 7 figure account balance in your qualified retirement settings, and you have to make some decisions, right? There's been much written about the fact that maybe the 4% withdrawal rule doesn't work. Maybe returns won't be adequate for a participant to be able to rely on a 4% withdrawal over their lifetime. And there's been a tremendous amount written about the benefits of potentially annuitizing some portion, transferring the longevity risk, the risk that you will outlive your income, away from your retirement account and to an insurance company who obviously would pool your longevity risk with the risks of thousands of other clients. That's a tremendous opportunity. We've had great success, I think, in the defined contribution industry for those that have for those that at least are covered by retirement plans through automatic enrollment and auto escalation and other factors to grow and accumulate massive wealth within these plans in a number of areas. We have not developed particularly sophisticated methodologies from which to spend down those accumulations. So as financial services institutions look, there's certainly an opportunity because there isn't good product development there. But there's also a pretty significant inherent profitability motive for insurance companies to look at this marketplace. In 2017, immediate income annuity sales were only $8.3 billion. We're now in a plus $8 trillion marketplace. If they can successfully communicate to participants the opportunities in annuitization, there is profitability clearly to insurance companies in taking accumulated defined contribution assets and working through a decumulation process by selling annuities to those participants. The insurers get the benefit of transitioning essentially what your retirement assets are onto their general account, and their actuaries determine how much they can successfully pay and still generate the types of target profitability levels that are out there. This is such an important area that a number of competitive insurance companies in 2018 formed the Alliance for Lifetime Income. So essentially a trade group whose primary efforts are in trying to communicate the benefits of annuities to participants. And whatever you're feeling about annuities within this structure, they've committed a tremendous amount of assets. So the Rolling Stones are on their, what I think might be their 79th final tour. And that entire tour is being underwritten by this Alliance for Lifetime Income. So they're targeting the right participants. My kids clearly aren't going to any Rolling Stone concerts anytime soon. So they're targeting the right groups, and they're expending tremendous amounts of time and money to try and communicate and seize the opportunity that annuitization provides for them. So my point in addressing those 5 issues is not necessarily to say that any 1, 2, 3, 4, or 5 of them are problematic. I think, frankly, all of them have both risks and opportunities. Good proprietary funds should be used without regard to record keeping. Managed account solutions that generate better outcomes, are reasonably priced, and provide value to participants should be considered and utilized. IRA rollover solutions, having a good, competent IRA rollover solutions for participants who may not want to stay in a retirement plan is clearly of value to participants in the marketplace. Even the notion of financial wellness and having the ability to buy products that may augment your retirement plan could be considered beneficial. And clearly annuitization from a mathematical perspective can provide significant retirement security to participants. That said, any of those should be monitored as part of an ongoing healthy fiduciary process, continuing to drive down the cost of administration without reviewing the consequences of that, which largely fall in this new subscription model, I think carry significant risks to organizations, but also to participants. I think the clients we work with, we really benefit from working with organizations that care deeply about allowing their participants to be successful in accumulating retirement income, and allowing them to be sold products that don't help them achieve that outcome, and have them be perceived as being endorsed by a plan sponsor, carries risks that may not be legal or fiduciary, but just may have an impact on how effective your retirement benefit program can really be. So I'm going to start with two different things that I think plan sponsors should think about. Let's start with the addressing revenue lines inside the plan. That would be proprietary funds. It certainly would be managed accounts. These are areas where plan record keepers within the plan may be trying to augment revenue sources. So what can you do to both manage that and document it? Certainly, the first step is always to understand how your providers are compensated. As I mentioned before, you now should be receiving, certainly if you're an ERISA-governed plan, a 408b2 disclosure. All of our clients annually get a disclosure from us. This is how much we charge. We're a fiduciary of the plan. This is all we receive. Each year, again, those same ERISA plans should be providing their participants a 404a5 disclosure, which says this is how much you're paying. And these are all the other things that we might sell you within the plan. That would include managed accounts, or any other services participants may be eligible for. And then last but not least, take a look at your Form 5500 filings, that Schedule C. Who's getting paid? Who was I unaware that's getting paid? And when I do that, it gives me enough information, at least to have an understanding about how my various service providers are compensated. From there, you have to address the issues of customization. So in looking at your service agreement, are we asking our providers to do more for us because of our unique nature? Could be employer stock, could be multiple payroll feeds, could be that we have a high volume of participant counseling, all things that would impact our price. 3, you got to review the quality of the service providers, and that's certainly the Recordkeeping Administration. Are they doing good work relative to the fee we're providing? But it's also all those other providers that may be selling services. So is the quality of the managed account solution one that we're happy with and is consistent with the marketplace? And then you've got to evaluate that compensation to the broader market. The market is changing tremendously rapidly. We've seen consolidation over the last 4 to 5 years, and we're seeing a transition now where providers are less concerned with how much they're making on the record-keeping administration side and more concerned with what services they may be able to provide or augment to help build a more comprehensive and economically more viable relationship with the client. And once you've made those determinations that fees and services are reasonable, that you've bought and added the right fees and services within the plan, documenting that through your minutes. Let's talk about the revenue lines outside the plan. Could be IRA rollovers, could be the cross-selling, in some cases may even be the annuitization aspect. Similarly, you're going to need to review the other sources of revenue from the plan. You're going to need to look at the disclosures I mentioned earlier, the 408, the 404A5, and the Schedule C. You're also going to have to determine the materiality of those revenue lines. So if, for instance, your plan has a cross-selling effort, but ultimately there's never been anybody on campus or the shop floor making those pitches, the likelihood is the materiality of it is not significant. You should be requesting information from your provider, arguably, about how frequently participants are electing to roll over into a proprietary solution with the same provider, so that you can get some notion of whether the cross-selling opportunities are really driving the relationship, or they are a very minor part of a much more important record-keeping relationship. In doing that, there's always the determination as to whether the services are reasonable. Having an IRA rollover solution seems very reasonable. Having one that participants take advantage of 82% of the time when they leave your employment seems unreasonable. So how do you document that and get comfortable with the information and the relationship you have with your record-keeping provider? And then when you do that, go back and make some determination as to whether these non-planned services require disclosure. Not require disclosure in so much as they need to be disclosed on your mandatory disclosures, but it may create an opportunity to mitigate risk for you as a plan sponsor. So for instance, making with your 404A5 disclosure a notice to plan participants that says, hey, organization XYZ provides financial counseling. However, anything that they may be doing outside of counseling you relative to your balance in the 401k account is not covered under our service agreement, and as a result is not being reviewed by the employer. I think it's important as plan participants look at their relationship, they look at the relationship with the plan provider as being one provided through their relationship of employment. And while that avenue is certainly created, I'm unaware of any plan fiduciaries out there that are reviewing long-term disability sales that may be tied to a 401k relationship. I don't think that's your obligation. And as a result, I think it's helpful to point out to participants that whatever buyer beware obligations they may have in other aspects of their life would also hold true here. And that leads us to the last piece, which really is what's next on the horizon for the retirement plan marketplace. And I think a few things. I think consolidation will continue to increase. I think it is very, very difficult, given what's happened in the marketplace, for small providers to compete from a technology perspective and service perspective with what are these increasingly growing monoliths on the record-keeping administration side. I think we're going to continue to see service providers push the managed account element. I think we have seen tremendous uptake in target date utilization and driven both by the Pension Protection Act, but also by automatic enrollment and auto escalation. I think that many record keepers see those target dates as a fundamental risk to their business model. Managed accounts do two things. One, allows them to grow revenues by selling additional products, but also reduces their dependence on target dates as being the exclusive investment option. I think there'll be enhanced efforts to launch products and services within those 5 elements. We're already seeing work on the annuitization side. How do we change the form of benefit and lay that out in a way that's compelling? That's not going to stop. I think that's going to continue at a pretty aggressive rate. We're going to continue to see expanded project and participant fees. So more fees being moved out of the administrative center and moved on to participants. Those are subject to exactly the same fundamental review that your administrative fees are. But in the RFP marketplace we exist in, it is competitively advantageous for record keepers to move fees out of a base fee and onto a project fee to make themselves be perceived as more competitive than they may actually be. And a continual emphasis really on the power of scale. And the way I see it, actually, the marketplace may actually go back to one that I came into in 1995, where we begin to see more delineation between 2 different service provider models. With one model on the investment provider side, you're going to see increased integration and a philosophy related to financial wellness, looking at the participant as a whole, both on the retirement side and other elements of where they may work. We're going to continue to see massive scale focused on participant services and vendor reporting, driving out the individual interactions with people, driving people to technology where those services can ultimately be delivered more effectively and efficiently, and automation really of the entire service structure. And on the other side, I think you're going to see a more boutique, independent third-party administration solution where the focus is on flexibility and customization, developing solutions that can't be accommodated in a mass technology type environment. They're going to remove the conflicts probably relative, potentially selling products and services to participants to be a more pure version of what some plan sponsors may be seeking. And we're going to look to provide a higher touch to try and compete with these technology organizations. Either model, I think, ultimately can be compelling, so long as the committee understands what they're buying and puts adequate protections in place to ensure that what they're buying delivers the right types of outcomes and results to participants. So I carried a little longer than I wanted to. I apologize. That said, I did want to open it up for questions that people may have formulated over the course of the presentation today. I'll give everybody a chance to type. It's a good typing test to see how quickly or slowly people type, or whether they had any questions at all, of course. Well, I want to close by saying, as always, we appreciate you participating in today's webinar presentation. I think we are at an inflection point, and I think it's one that you as plan sponsors should be aware of, because while it's happening on the Recordkeeping Administration side, I would add to that we're seeing something very similar happen in the investment consulting marketplace. There was recently a conference in Vegas for retirement plan advisors, and much of the focus of that conference seemed to be on how firms serving in a fiduciary capacity could combat fee compression. And essentially the model that was being advocated was one not dissimilar to what's happening on the Recordkeeping Administration side. Sell more things, do more things for plan sponsors, which I think ultimately creates a challenge. We as a fiduciary organization have to be in a position of independently assessing the providers and providing counseling to the clients that we serve. This transition, or this muddying of the relationship between the investment consultant and the investment manager, is one that's troubling. And we're seeing it increasingly, where investment consulting firms are trying to be asset managers as opposed to the independent fiduciaries reviewing investment performance. Watch for that on the horizon, those organizations you're working with. We're very committed to the independent investment consulting model. We're noting that others seem to be committed to a different path. So thanks for your time today. Again, appreciate, and to the extent that you have questions that you may formulate over the course of the next week, do feel free to reach out. I'm always happy to have a dialogue. Thanks for your time, and have a great day.